Have ever heard the word stock market or shares and your mind sounds like, what is this again? In this video, I will break down how the stock market works in a relatable way and show you some of the best ways to start investing in the stock market for profitability and growth. Stay glued to the end as there is an unpopular investment idea you don't want to miss. Before we continue, I want you to know that investing in shares is one very good passive income avenue to create wealth. But there is a how. You will understand this better as we go on. What is a share? Let me explain it in a simpler way. When we buy things like food, clothes, and medicine, we usually buy them from big companies that make a lot of these things. These companies are called mass producers. It's usually a good idea to invest money in these companies by buying a little piece of the company called a share. This way, if the company does well and makes a lot of money, the share that you bought will become more valuable and you can sell it for more money later. But before you do that, it's important to check if the company is doing well and growing so that you make a smart decision. Contrary to the opinion of some advisors to invest in the stocks of the company you use their product when you want to buy shares in a company, don't just do it because you use their stuff. It's better to think about how many other people also use their stuff. The more people who use the product, the better it is for the company. That means they might make more money and be more successful. So, it's important to think about how many people are using the product before you buy shares. How does the stock market work? The stock market is a place where people can buy and sell pieces of a company. When a company wants to raise money, it can sell these pieces to people. The price of these pieces can go up or down depending on how well the company is doing, how the economy is doing, and how people feel about the company. Investors can choose to keep their pieces for a long time or sell them quickly to try and make money. The stock market can be tricky to understand, but it's a way for people to invest in companies and try to make more money over time. Now that you understand the term shares and how the stock market works, let's move on to how you can profit from it as a beginner. If you're a beginner and interested in investing in the stock market, there are a few things you should keep in mind. We want to prepare your mind before telling you what you can invest in. Investment apps you use easily, especially as a beginner, towards the end of this video. First, it's important to do your research and learn as much as you can about investing before you start. There are many books, websites, and videos like this available that can help you understand the basics of investing and how the stock market works. What you know and how you apply that knowledge can be a defining factor in your personal development and achievements. Continuously learning and applying new information can broaden your perspectives and help you make informed decisions. On the other hand, being complacent with what you already know can limit your growth and hinder your potential. It's important never to stop seeking knowledge and to always strive for personal growth. So concerning the stock market, you may need to unlearn and remove some negative beliefs stuck in your head to be able to benefit from investing in it. For example, an investor named Peter Lynch believes it's important to study a company really well before deciding to invest money in it. This means learning about what the company makes, who runs it, and how much money it makes. By doing this, an investor can make smart decisions and maybe even make more money. Peter Lynch says it's better to do your own research instead of listening to other people or following what everyone else is doing. It takes patience and hard work, but it can help you do better with your money in the long run. Second, don't just rush off to buy shares after watching this video or similar videos. Consider working with a financial advisor or broker who can help you navigate the market and make informed investment decisions. They can also help you create a diversified portfolio that includes a mix of different types of investments, such as stocks, bonds, and mutual funds. Let me illustrate this by using an imaginary character named Paul. Paul is a young man who has just started earning a good salary. He has heard a lot about the stock market and wants to try his hand at investing in shares. Excited by the prospect of making money, Paul decides to invest in a company he has heard is doing well. Without seeking professional advice, he invests a significant amount of money in the company's shares. At first, everything seems to be going well. The company's share price is rising, and Paul is pleased with his investment. However, things started to go downhill when the company announced that it had been facing financial difficulties. As a result, the share price plummets, and Paul, scared that the company's share price will continue to go down, sells off all his shares, and Paul ends up losing a significant amount of money. Paul realizes he made a mistake by not seeking professional advice before investing in shares. He learned the hard way that investing in shares without proper knowledge and advice is risky and can lead to significant losses. He decides to seek professional help and educate himself before making any future investments in the stock market. Third, It's important to have a long-term perspective when investing in the stock market. The market can be volatile and unpredictable in the short term. The stock market can be volatile and unpredictable in the short term due to several factors. One such factor is economic indicators, such as inflation rates, unemployment rates, and GDP growth. Any unexpected changes in these indicators can lead to a shift in investor sentiment, resulting in a sudden rise or fall in the stock market. Another factor is political events. Changes in government policies or international relations can have a significant impact on the stock market. For example, a new trade agreement or a sudden shift in foreign policy can cause uncertainty and volatility, leading to fluctuations in stock prices. Company-specific events can also make the stock market volatile. For example, a company reporting higher than expected earnings can lead to a surge in its stock price, whereas a company reporting a decline in its earnings can lead to a drop in its stock price. Finally, market sentiment or investor behavior can also make the stock market volatile. Fear, greed, and panic can all contribute to sudden fluctuations in stock prices, leading to a volatile market. It's important to note that while short-term volatility in the stock market can be unpredictable, the long-term trend of the stock market has historically been upward. It's essential to take a long-term view when investing in the stock market and not get swayed by short-term fluctuations. By investing for the long term and not reacting to short-term fluctuations in the market, you may be able to achieve more stable and consistent returns. For example, Warren Buffett is a well-known investor who is famous for his long-term investment strategy. Buffett believes in investing in companies that have a strong competitive advantage and are likely to grow over the long term. He looks for companies with a solid business model, stable earnings, and a competent management team. Buffett's investment philosophy is based on the concept of value investing, which involves identifying undervalued stocks and holding them for the long term. He believes that investing in quality companies at a reasonable price and holding them for a long time is the key to success in the stock market. Buffett's long-term investment approach has been very successful, and he is considered one of the most successful investors of all time. His investment company, Berkshire Hathaway, has a long-term investment horizon, and he has famously held on to some of his investments, such as Coca-Cola and American Express, for decades. Finally, it's important to be patient and disciplined when investing in the stock market. Don't let emotions or hype drive your decisions, and stick to your investment plan even during periods of market volatility. Overall, investing in the stock market can be a rewarding way to grow your wealth over time, but it's important to approach it with caution and a well-informed strategy. Let's illustrate this with our imaginary character, Celine. Celine is a young woman who wants to try her hand at investing in shares. She has heard about a new company that is doing well and wants to invest in its shares. Celine is excited about the prospect of making a quick profit and decides to buy the shares without doing any research. As she waits for the share price to rise, Celine becomes impatient. She starts to follow the market trends and buys and sells shares based on what everyone else is doing, without confirming the information. She is more interested in making a quick profit than in investing for the long term. Unfortunately, Celine's impatience and her tendency to follow unconfirmed trends lead to significant losses. She realizes that she made a mistake by not doing proper research and by following the crowd blindly. She learns the hard way that investing in shares requires patience, discipline, and a long-term perspective. Celine realizes that she needs to educate herself and seek professional advice before making any future investments. She learns that investing in shares is a long-term game, and the key to success is to invest in quality companies with a solid business model and a competent management team. She decides to adopt a more patient and disciplined approach to investing, and starts to research and analyze companies before investing her money. Good, you have the right mindset about the stock market now. The next question is, what exactly should you invest in? Before we continue, subscribe to the channel for more valuable topics like this. Let's move on. If you're just starting to invest in stocks, it's a good idea to begin with something called index funds. These funds are like a basket of different stocks that follow a big group of companies called an index. They're a safe and easy way to get started with investing, and they don't cost a lot of money. It's like having a bunch of different toys to play with instead of just one. An index fund is a type of investment fund that tracks a specific stock market index, such as the S&P 500. Think of it like a big basket of different stocks from a bunch of different companies. When you invest in an index fund, you're essentially buying a tiny piece of that basket. The value of your investment will then go up or down based on how well the companies in the basket are doing. One of the main benefits of index funds is that they offer a diversified portfolio of stocks. This means that you're not putting all your eggs in one basket and risking losing everything if one company does poorly. Instead, you're investing in a group of companies, which lowers your overall risk. Another advantage of index funds is that they have lower fees than actively managed funds. This is because they don't require as much research or effort to manage. As a result, more of your money goes towards your investment rather than paying fees to the fund manager. Overall, index funds are a great way to get started with investing in the stock market. They're easy to understand, offer diversification, and have low fees. As you learn more and get more experience, you can try different things to make more money. If you feel that index funds are not satisfying your investing needs and you want to try investing in individual stocks, then it's generally a good idea to invest in companies that produce products that are commonly used by a lot of people. This includes companies like Coca-Cola, Apple, or Nestle, which are well-known brands that offer products that many people use and purchase on a regular basis. Investing in these companies can be a smart choice because they have a history of success and a strong brand reputation. They also tend to have a large customer base, which can provide stability and consistent revenue. Additionally, these companies often have a competitive advantage in their respective industries, which can help them maintain their market share and profitability. However, it's important to do your research and understand the risks involved with investing in individual stocks. While companies like Coca-Cola, Apple, and Nestle are well established and generally considered to be stable investments, there is always the risk that their stock prices could go down due to factors such as economic downturns, changes in consumer preferences, or increased competition. As such, it's important to diversify your investments and not put all your money into just a few individual stocks. For regularly cash flow, it is also important for you, an investor, to invest in dividend-paying stocks. Dividend-paying stocks are a popular choice for investors who are looking for a steady stream of income. Here are a few examples of well-known companies that pay dividends. 1. Johnson & Johnson J&J, a healthcare company that produces a wide range of products from medical devices to over-the-counter medications. 2. Procter & Gamble PG, a consumer goods company that produces a variety of household products such as Tide laundry detergent and Pampers diapers. 3. Coca-Cola KO, a beverage company that produces soft drinks, juices, and other beverages. 4. Verizon VZ, a telecommunications company that provides wireless and wired communication services to customers. 5. ExxonMobil XOM, an energy company that explores for and produces oil and natural gas. These companies are just a few examples of dividend-paying stocks that offer consistent income for investors. It's important to note that while dividends can be a reliable source of income, there's always the risk that a company may reduce or suspend their dividend payments due to economic or business conditions. As such, it's important to do your research and invest in a diversified portfolio of stocks to minimize your risk. Here are a few investment apps in the United States of America: Robinhood, TD Ameritrade, E-Trade, Fidelity, Charles Schwab. While in the United Kingdom, investment apps include Trading 212, Hargreaves Lansdown, eToro, Freetrade, and Interactive Investor. Kindly mention some investment apps in your jurisdiction in the comments section. If you enjoyed this video, hit the like button and say yes in the comments section. Don't forget to seek professional advice before you invest. This video is not a substitute for your due diligence. See you in our next video shown on your screen.